Welcome to the DJE podcast, where you will learn about real estate investing from real life examples. Here's your host, Devin Elder.
Hello and welcome to the show. Thank you for joining today. My guest is Chris Lento. He's the founder of EM Capital Group, a former aerospace engineer in Boston. And like a lot of us has got the real estate bug, started doing his own deals. In his case, these three-story houses that are very common in Boston, where you've got different tenants, a different tenant basically living on each floor, very common up there. He got into that, had success with that, started expanding that, and then started expanding to other markets and growing the type of assets or the size of assets he's getting into. And then bringing on outside capital too, which is kind of, for a lot of operators, the ultimate accelerant when you're bringing on outside capital lets you go do bigger deals. So great story. Chris is a really sharp guy. We talk about how he built the business, how he's running things, how they're looking at deals, current market conditions. Just a sharp guy, and enjoyed getting to know a fellow real estate entrepreneur. So I hope you enjoy it as well. Let's get into the episode with Chris. This episode is brought to you by DJE Texas Management Group, a San Antonio, Texas-based real estate investment firm with a track record of transacting on several $100 million of multifamily, land, and industrial deals throughout Texas. DJE's been in business for over a decade and is approaching 100 team members in San Antonio. To learn more about DJE, visit djetexas.com or the link in the show notes of this episode. This episode is also brought to you by apartmenteducators.com, a complete ecosystem for professionals to learn how to find, finance, and operate large multifamily properties for profit. You can get started with a free mini course and learn more at apartmenteducators.com or visit the link in the notes. Chris, welcome to the show. It's good to see you. How are you?
Good. How are you?
Doing great. I appreciate you jumping on today. Looking forward to diving into some shop talk here on the real estate front. But before we do that, how about some background on you, some info for the listeners? And always love to hear your story about where you started out and how you got into investing.
Yeah, of course. So I started in my career as a systems engineer in the aerospace industry. So I worked for a defense contractor here in the Boston area for 15 years, doing big Navy contracts. And in parallel, I was investing in these 3-deckers or 3-family apartment complexes here in Boston. They're kind of everywhere.
Yeah.
So kind of viewed it as a side hustle or something good to have when I retire.
Yep.
And I just really liked it. I liked it more than my regular job. And I didn't see it as scalable. So as I sort of grew in my career, and I was in DC for a couple of years, and I saw sort of the procurement side of all these defense contracts, I started thinking, well, how do I switch over? Because I can see this whole industry and it's just massive. And I'm sort of a classic engineer. I like to get things done, make progress. And these projects were just enormous, and they were very political. And I was just kind of sick of it.
Yeah.
Started scaling my stuff to larger apartment complexes, bringing in outside investors. And then it kind of clicked. All right, this could be a career, not just a sort of a side investment activity. So 6 years ago, things were financially in a good spot. So I left my company and started my own company. And then, it's been going really well since then. Strong growth and, learning a ton, constantly.
Yeah. What were some of those first projects that you were in, those real estate investments that you're doing while you're also having the W-2? Was it smaller projects, or were you like a limited partner on somebody else's bigger deal? What did those look like?
No, they're smaller projects. So like I said, Boston has a lot of these 3 families. So there's 3 apartments stacked on top of each other.
In one house, right?
It's like a vertical flat roof, or sometimes pitch roof, 3-unit. So there'd be like a 2-bedroom, 1-bath, 2-bedroom, 1-bath, 2-bedroom, 1-bath, all stacked. It's like a really common product up here in Boston. Yeah. There's some in Philadelphia too.
My brother lived
northeast.
Yeah, we'd visit him, and he'd have the second story. Him and a couple roommates.
Yeah, it's very common. So I bought one of those in East Boston, which is kind of the airport neighborhood. And it was a little bit kind of off the beaten path at the time. And I lived in one, and as the others became vacant, I either moved into it or I fix it up, on a turn. Did that for maybe a year or two, took the equity, got a HELOC, bought one down the street, did the same thing. And then rolled into a 5-unit, probably about $1 million building, about 45 minutes from Boston.
Right.
And this was when I was starting to think, all right, Boston's expensive and the cash flow is tough. So, where else is there a better, at the time I was thinking like rent to price ratio, not just very simplistically.
Good metric, right? Shoot from the hip. Good metric.
Right. Yep. Exactly. And then, I was starting to think about the Southeast and not a Boston market. So I bought a property in Salem, Mass, which is 45 minutes away. And this is the first time I hired a full-time property manager to run it. I was running the day-to-day before. Yeah. And I was, in my head, I was like, all right, this place is in Florida. Like, you're going to visit it every 6 months.
Can't go there.
Trust. Right. Yep. You can't fix a toilet. You can't go up there to solve some sort of problem. And so I visited it, probably every 3 months. Yeah. But I treated it truly like it was, not accessible. And it worked out really well. I enjoyed the freedom that gave me. Yeah. I learned how to manage the property manager. And then that gave me the confidence to 1031 exchange that property into a 24-unit in Florida, actually. Excellent. Tallahassee. So
you actually went Florida on that next one.
I did. Yeah.
After practicing it.
Yeah. Which was just a coincidence. So.
Oh, that's funny. That's funny. It's interesting investing remotely. We've kind of taken the opposite approach and invested pretty much in San Antonio and surrounding areas. But one of the things I think about is just kind of deal flow, right? If you're searching nationally and you're, kind of a startup private equity, how'd you manage deal flow? How'd you get the Florida deal, right? Did you look at 1,000 deals in 20 states, or were you pretty set on that one market? What did that look like?
Yeah. I mean, maybe if you have a big shop, you can look nationally, but it's impossible, right? Like, you can't know the national market, and develop those broker relationships. So I kind of picked markets, right? So I had targeted Tallahassee as a potential up and coming market, and at the time I had targeted Jacksonville. They're about a 2-hour drive, so I focused on those two markets. Found out who the major brokers were in those markets, establish a relationship with them, try to get on the phone with them every couple of weeks, get on their email lists, get their deal flow, start the relationship so I could get those short list deals that, didn't make it to the email blast. And that's how I've really kind of developed my portfolio since then. So targeting markets of interest, with, periodic reevaluation. Like, is this market sort of past its peak, or isn't what I thought it was going to be? Or is there another, with the Inflation Reduction Act, there's a lot of huge infrastructure projects going on around the country. So it got me thinking, well, where are these going to impact, and what is the ramifications of these 10,000 jobs going to be
on housing
in the next 5 years?
Yep.
So there's pros and cons. I mean, I think if I had been in Texas, I might have a different approach, because the market's different. But being in the Northeast, that was my approach.
Yeah, it makes a lot of sense. Niche down on one market, it takes a lot of time to build those relationships. I want to run something by you that I talk to a lot of kind of newer operators or aspiring operators, and managing deal flow is a challenge. You picked, one market specifically that solves a lot of the problems, but what's your feedback for people on, let's say you are building a new broker relationship in a new market? You want to get feedback to them. I mean, they want quick feedback. Did you develop any systems or processes to say, hey, John Smith in Tallahassee is a broker I want to build a relationship with? What's the process to kind of make sure you're looking at deals and getting feedback in a timely manner to where they're going to start taking your calls? Right.
So, first would be, figure out who's doing, the majority of the deals. So we got John Smith, check out, get on his email list. So go to their website, sign up as an interested investor, check all the boxes about asset class that you like, size, whatever kind of interface has. So now you're getting their emails. Pretty much the first email you get, or even grab one off their website and just call them and kind of introduce yourself, but ask them about the deal. Brokers like cold calls, but they want to talk about the deal. And
Sure.
so pick one that you're mildly interested in and use it as a test case. Just kind of introduce yourself, talk about it, establish that relationship. Once you have that person, in your system, I use Monday.com to track my deals. I've set up sort of like a 12-step pipeline process, and
Love it.
they come in, and so now all my emails come in. I have an executive assistant who screens them for state, size,
Yep.
asset class, vintage. If they don't pass, there's an automatic email response that goes back to the broker and says, hey, I'm not interested, here's why. If it's from left field, like if it's a Utah shop that I never really expressed interest, I'll just unsubscribe to that.
Right.
And then there's 3 stages through my early pipeline process where if they move to the next one, there's kind of a canned email that goes out that says, hey, John Smith, we were taking a deep dive into the underwriting on this one. We like it because, and I can put in some, specifics to that deal that key off of that. And I put that in place probably about 4 months ago, and
Right.
it's been very well received. I think the brokers know it's canned, but they're like, at least I know something's happening. It's not just sending it into the ether.
Yeah, nothing's worse than just being ghosted for a broker
Right.
or anybody. So at least you're getting something.
Yeah. And then if they go into the pass bucket, there's also a similar, email that says, we're going to pass on this one because, and I can type into the system, what the reason is. I don't like the location, crime's too high, what have you, but, keep them coming. And then and they'll get that. So they sort of can cross me off their list. And a lot of those emails will spur calls. They'll call and be like, wait a minute, no, you got the location all wrong.
Yeah. Good. Yeah. That's valuable.
Yeah, exactly.
That's valuable feedback. I love it. There's a real peace of mind too that comes with kind of systematizing and automating those things where you kind of know where your deals are in the pipeline. And, we can set up kind of a similar thing for so many of our business processes where I just look at my tasks due this week. And if it's not on there, I'm not thinking about it,
Right.
because know that when there's any number of things, a loan maturity or, any one of 1,000 business tasks that I need to have on my radar, it's going to pop up at the right time, and the system is going to handle that. And it just creates like all this offloading of these mental cycles that you can put in the CRM or whatever the system is. And that just makes work more enjoyable for sure.
Oh yeah, absolutely. And a lot of that stuff kind of weighs on your background mental processes.
It's taking cycles, which is it's not doing anything, but it's still taking mental cycles. Yeah. It's like, God, just get this out of my the short-term memory, just pull it out of there.
Yeah, no, absolutely.
Yeah.
And especially with deal flow, like if a broker calls you, if your relationship with a dozen brokers, it's nice to be able to, click their name in your system and you pull up the deals they're associated with, and you can get to it fast.
Yeah.
So yeah, there's a huge value to having kind of processes in place.
For sure. Deal merge gets thrown around a lot, from every broker and lender we talk to. I got an email today on a deal we have under contract. We're trying to, close it. And they're like, hey, we need these 3 pieces of information. I was like, this is not making sense. Is this on this property? And they were like, oh, that's one of our other deals. Sorry. I was like, there you go.
Right. Yeah.
Happens to everybody.
Happens to everybody.
Yeah. Well, that's good. That's good feedback. And I think that's, super important to start to build out your system so that you are, only using those CPU cycles in the brain for those more important things. I want to get a sense for you, you did some of these deals on your own. That's how I started. That's how lots of other people have started, kind of starting with their own capital, maybe in their backyard, and then seeing some potential and then growing that over time. What was the process like for you going from, hey, this is, kind of a test case, it's my money, it's my deal, to actually bringing on investor capital? How did you make that switch? That's a big turning point, I think, for a lot of us.
Yeah. So when I did that 1031 exchange into the Florida property, I viewed that as a test case.
Yeah.
It was a bigger property. It truly was out of state. I had been, I think, dramatically improving my understanding of real estate at the time, and was now underwriting it like you underwrite, and not like I was before, which was like very cash flow based and very amateur looking back.
Yeah.
And I said, all right, let me make this big transition, buy this bigger property out of state, and I'm going to treat it like it has investors.
Nice.
I apologize. What's
Very
happening here? So I used that Florida deal as a test case. And I, underwrote it with investor metrics and general partner metrics and looked at it, like it was a GPLP deal. And then once I got about 6 months under my belt on that, in parallel, I'd sort of been ramping up my marketing and talking to friends and family and friends of friends about, that I was going to start doing this basically career change.
Sure.
So that gave me the confidence. And I got good feedback. I was surprised with how many people are unaware that you can make kind of private placement investments out there. Incredible. And how excited they were about it.
Right. Everyone wants to do it and they don't know the on-ramp. It's like every adult that has kind of some modicum of financial wherewithal wants to do it and they don't know how. It's amazing.
Yeah, absolutely. So that was, very confidence building that there was this demand out there. And yeah, that just basically gave me the confidence I needed to make the jump and start sort of marketing the first deal that I got. And the first deal that I actually marketed was a partner deal. So someone that I had, association with kind of got late stages in a closing and needed capital.
Sure.
And they knew that I was starting. So we partnered together on a deal, after I vetted it, obviously. And that was, my first raise. It wasn't huge. It was maybe like 600,000.
Yeah, it's good.
That I had to bring, but
yeah, especially starting out. And that's a very common structure, one we kind of talk a lot about with operators. And that was even my first kind of, not quite solo, but my first multifamily that I was like the primary lead sponsor on after doing a couple smaller deals with other more experienced partners was 130 units where, hey, it's me running this deal. But I actually had a friend in Boston that came in and he raised a little less than half the money and helped with the loan guarantor situation to kind of get net worth and liquidity across the line. And it was a great partnership, just kind of a one-off deal where half the investors were in Texas with us, the other half were in Boston, and my partner was in Boston. But it's wouldn't have, neither of us would have got the deal without the other. And it worked out great, And what's cool about those partnerships is they can build your career, but you're not, my private equity company, I don't have a partner. It's just me, right? All these other companies I have, for the most part, they're my companies. I don't have long-term partnerships for the operating companies, but deal by deal, let's do a partnership that maybe lasts 3-4 years and has a very specific outcome, and then you get out. If it makes sense to do it again, great, but you don't have to, and it just creates a lot of flexibility to get these deals done. Yeah,
and I found the same thing. Like I would say, that discovering the out-of-state sort of larger model, making the recognition that outside capital was a huge growth opportunity, and then finding kind of strategic partners, like you said. I don't have any partners in my core business either.
Sure.
But on many of my deals, I partner with other syndicators doing very similar things that I'm doing, because we can handle, bigger properties that are higher quality, better property management. And it takes, you can create a team environment, but it's not permanent, which is nice.
Yeah, that's right. And these deals, one of the things I like about these larger deals is the pie is just bigger. I mean, I've done a bunch of these, but you partner with somebody to flip a house and there's, $20K of net profit after it's all said and done. And then you pay taxes and cut it in half. And it's like, that's just not very exciting.
Not worth the time. Yeah.
A $10 or $20 million deal. Like, okay, we're talking about some bigger numbers here where there's people that are professional and make a very strong, W-2 earning it can be compelling for those kind of people. So that's a nice component of doing the bigger deals.
Yeah. And I like on the bigger deals that most of the people you work with are of higher caliber.
I was just going to say that. Yeah. I mean, like the whole cast of characters, I don't know how much your experience on the 3-story stuff was, but I've done way too many single family projects in my life. And the cast of characters from wholesalers to agents to sellers, everybody's completely unsophisticated. And in the larger deal or in the commercial multifamily world, like you're talking about quality players. I mean, from the broker attorneys to sellers, everybody's like relatively sophisticated. It's a breath of fresh air for sure.
Yeah. Yeah. And they're not just sophisticated, but they're going to be there for a while.
Right.
Right. Like I feel like in the smaller stuff, like that broker may not be a broker in a year.
Right.
Like that GC may not be a business in a year because they're sort of, why are they taking my, 20K job if they're like a high-end general contractor or so they're going to either be playing with bigger fish in a year or they'll be doing something else because it didn't suit them. And when you get into the 20 million plus or even lower than that apartment complexes, your PMs have a company. They manage tens of thousands of units. They have structures in place. They have, if someone quits, they have backfill capabilities.
Yeah.
So that's nice. Business. Stability.
Yeah. Stability, established businesses, those kinds of things makes it really nice. How's your experience been? Kind of your perspective now, having done this for a number of years, that kind of owner versus the employee role that you had before. I've been in both, and they're different worlds. But what's that experience been like for you?
Meaning, like business owner versus being personally a W-2 employee.
Yeah, like coming from your career as a W-2 employee to now being a business owner, obviously very, very different life in so many ways. But what has that transition been like for you?
It's been interesting. I think I was well aware that it was going to be a transition because I was at the same company, which was like a it was a defense company, very stable.
Sure.
Like I didn't even really pay much attention to the Great Recession. It was like, well, okay. Like I read the news, but beyond that, I was unconcerned. Yep. So just the general stability changed quite a bit. And I was aware of that. I sort of put some processes in place about, moving money automatically into my checking account. So it kind of seemed like I had a paycheck kind of thing. And, but a lot of that stuff, once you get used to working for yourself and having sort of variable income, that, kind of got over that pretty fast. And then as far as just the sheer amount of functions that you have to have as a small business owner, I thought it was great, honestly. I feel like I was just constantly learning about new ways the world works that I just took for granted in the past. And there's frustrations, like who likes to be their own IT department, right? Right. But but overall it's been great. It's been, I think, way more productive than I was in my kind of regular job because I could see the big picture and I knew that there was, growth potential and that growth potential was, very high. It wasn't like 4% raise growth. It was, maybe we'll double next year kind of growth. Right.
Yeah, it's very exciting and very motivating. And that really resonates with me. It's been my experience as well. And something you said earlier about, especially the environment you were in, huge projects, big bureaucracy. It's frustrating. I think it's a frustrating environment for achievers where it's like, hey, you just kind of got to sit tight on this thing and you're not really, it's this thing's moving is so big and slow moving versus you obviously went to the other end of the spectrum, but you can have immediate impact on things. You can decide something and take action on it immediately. And I think for people that are wired to be high RPM, that's pretty satisfying environment to be in. I know it is for me to just say like, hey, my actions are going to be impactful. And then as an equity owner, they can be really impactful. And there's a very direct correlation that was one of my frustrations in the corporate world. I just didn't feel like my efforts had the correlation that I wanted them to. So
and that's kind of by design, right? Like you're not a part owner. You're filling a function that has a market value.
Sure. So, and in retrospect,
sales.
Looking back, it's like there's some comfort in that too. There's a lot of worries that you don't, aren't yours. Yeah. Come in and do your job. But at the end of the day, I think, for a lot of us, it's just the best path for kind of personal growth is having a company or having companies, because it's a constant growth mechanism. It's been my experience, right?
Yeah. And I think you also get exposed to a different perspective in the people you interact with as well.
Certainly.
Entrepreneurs have a different take on things.
Yep.
There's not a lot of sort of complaining about obstacles. There's a lot of excitement about solutions.
Right.
So there's a general kind of enthusiasm in that group of people, which is nice. It's nice to be around. It's energizing.
It is. It's energizing, and it's inherently a bunch of problem solvers. So that is exciting to be around, and can be frustrating to be around if you are that, and then you're in a corporate environment that is 99% not that. I remember my last corporate job, I would go to lunch by myself and just throw in a real estate podcast because I can't be around you guys, and you're gonna be complaining about work for an hour at lunch with zero plan to change anything. You've been in this department for 20 years. I just can't do it. I can't be around, right? So there's certainly an element of that. So what are you guys, we're talking late 2023 right now. What are you guys seeing on deals? Are you looking at assuming existing debt with a little lower rate, maybe lower leverage? Are you looking at putting new agency debt on stuff? How is kind of the current, macroeconomic, whatever we're in right now, what you guys are looking at?
Yeah, so it's definitely a strange time. I don't think anybody really knows. Everyone seems to be waiting for something.
Yep.
And no one knows what they're waiting for. As far as the deals, so it's been an interesting quarter. We've been best and final on 4 deals.
Yeah.
Lost on price. A couple of them came back to us.
Yeah.
But Treasury, the 5 and 10 year have been moving sort of dramatically. Yep. Which has everyone, destabilized even more.
Yep.
So, when it came back to us, we said, well, that was 2 months ago's price. The price is lower now.
Yeah.
And so that didn't go over too well. So, but to answer your question more directly, we're looking at everything. A lot of the deals that are penciling are assumable debt. And, it's either a lower rate that you can get now, or it's maybe a floater that you have to buy a cap on, but it's got a higher leverage than you could get now.
Right.
Which, there's some, I think, risk associated with that. From a like a long-term execution perspective, how long is that floater for?
Right.
So we're sort of looking at longer term debt. If it is a floater, we're not obviously going to assume like a bridge loan or something that's expiring in 2 years.
Sure.
Because there's so much uncertainty. But we're looking at all options, and the sentiment out there is mixed. I mean, you'll find an occasional optimistic broker that thinks Q1 is going to be great, but I feel like everyone's sort of just waiting for, I think, the Fed to stabilize or the 10-year to be consistent for a month and a half or so.
Right.
I was talking to someone in my office. When you're looking at the 10-year Treasury every day, multiple times a day, something's not right.
That's not right. Yeah, shouldn't move.
That's not right.
Yeah.
No, I mean, you should be looking at it like once a week or something like that.
Yep.
So that just has to stabilize, I think, so everyone can calm down and say, all right, this is, sort of where we're standing, and this is how we can execute our business plan based on somewhat firm footing. Yeah,
100%. It's not so much the numbers, what rates are, what the 10 years at, but the velocity of the change is just
exactly.
If interest rates are going to be X, all right, we could start to build a plan around that. Mm-hmm. But if the floor is just moving on us all the time, it's really hard for anybody to kind of get any stability. We're hopefully further into this thing, or closer to the end than the beginning. It's been a while now. It's pretty abrupt set of rate hikes there that have changed everything. But I think we're all kind of hopeful for next year. See what happens with the Fed election year, and hopefully get some kind of stability. But seems like there are a lot of these assumable debt deals still out there if you can make the leverage pencil. And if a bunch of those transact and then that dries up, that'll be another set of issues. But seems like there's stuff coming to market with assumable debt, and then you're kind of figuring out the equity piece. But still looking at deals, right? I mean, it's like
Oh yeah,
we're going to be these perfect conditions. We have some conversations in our office with the acquisitions team, and it's like, guys, we're bidding on a deal. We're like the only group basically kind of making it. If rates change dramatically next year, there's going to be 15 groups again in these best and finals, and prices are going to be bonkers.
Yep.
And we're going to have a new set of problems. Maybe our debt rate problems will be alleviated, but then now our competition problems are going to go through the roof. So, it's always going to be tricky.
Absolutely. Because that's one thing we were thinking on this last deal we had was that, a lot of institutional investors are like pencils down for the quarter. So we were looking at a $50 million deal. Yeah. I'm like, we don't have the competition right now.
Right.
Like this isn't being bid up. So,
and you totally should. You absolutely should. In a more normal market, you would, but you don't. That's potentially a rare opportunity.
Right. Another thing we were considering was, no one wants a full financing contingency in there. Sure. And maybe we're back to those times soon, but some sort of indication on like our price offerings versus a 10-year rate.
Right.
Because you have this 90-day risk, right? You're not going to lock your loan for 90 days. And no one wants to just take a loss before you can close.
Right.
So, some sort of upfront discussion like, hey, here's a rough curve. Here's today is our price. We have no, 10-year treasury increase margin in that price.
Yep.
But if it goes up a quarter, this is what we're going to effectively retrade at. And, and then that begs the question, well, if it goes down a quarter, are you
coming up?
Will it come up? And I think you probably have to, right? That's kind of, if you're going to have that conversation, it has to go both ways.
Yeah. Yeah. We lost a big deal we were selling, had it under contract, and they came back with a pretty strong retrade, blamed it on the 10-year, and, they had a reason. Ultimately just didn't work for us. But when it moves that quickly and that materially, something's got to give.
Right. So we're thinking like that conversation up front could, alleviate that rather than everyone waste everyone's time and do a retrade, 30 days out. It's a lot of time and effort getting all this spun up only to back away.
Yeah. Oh, absolutely. Yeah. There's so many pieces involved and good amount of money involved potentially too on the acquisition side. It's always nice when they close and you go, okay, all right, all that earnest money and pursuit costs and everything else.
Oh yeah.
We just backed out of a couple of refinances, and I had, $90,000 with the lender on 2 deposits, and I'm going, man, I hope I get some of that back. And ended up, they just charged me for a couple of third-party things that had already been engaged, but got, 90% of that capital back. But
that's good.
Pursuit costs that we have on these projects for sure. So, yeah, that's interesting. Well, what do you see for the future of the firm? Is it kind of more the same with the existing setup and team, or are you looking at different markets, different asset classes, or just kind of continue to execute on what's working? What's your thought process on that?
Yeah, so I've always wanted to get into multiple asset classes. Yeah. So in this sort of downtime, I'm starting to spin out into industrial. Yeah. I always like the industrial class. I think there's
anything specific there, bay sizes or certain tenant types, or
I sort of gravitate towards the smaller multi-tenant kind of flex industrial, just because it has that like multifamily kind of vibe to it, right? You can have 8 tenants, and but I'm sort of just digging into how I want to structure that. But I think probably my first deal will be like a multi-tenant flex industrial deal. And really, one of the reasons is obviously Amazon and more online shopping requires more delivery industrial space. A lot of this onshoring that's happening right now with the EV business and a lot of renewable energy is driving a lot of manufacturing, which is going to have satellite hubs that are going to need a lot of industrial. There also just doesn't appear to be as much competition. I mean, try to find an industrial podcast, right? Like no one's talking about it.
For sure. Yeah, that's right. It's a different deal. We started getting into that a couple of years ago. It's been a neat space. Low expense ratios, B2B, right? So, you know, your landlord law is a little bit different, at least in Texas. Although Texas is pretty landlord friendly in general, but you know, when you're dealing with a business lease, it's just pretty black and white as far as the courts go or anything there. So yeah, it's been neat kind of getting into that space and doing something a little bit different. You find out how multifamily is pretty complex. And if you can kind of wrap your head around that and do that well, other asset classes sometimes look like, oh, this looks pretty straightforward compared.
Yeah. Less moving parts.
Apartment complex. Yeah.
Yeah, no, it's true. And you'd think it'd be the other way around, but it kind of isn't.
Right. Yeah. So that's good. That's good. I think that makes sense to start looking at other stuff and ways to deploy capital. Are you guys pretty similar in your offerings where it's like, hey, this is a equity offering, investors own, I don't know, 50, 60, 70% of the deal. And, you know, there's a pref, or how do you structure it differently per deal? What's your approach to that?
Yeah, I'd say like, you know, we're pretty standard in the multifamily market. So typically we have a pref, you know, anywhere between 6 to 9%, depending on really what you can get out of the deal for cash flow.
Yeah.
You know, investors typically own, you know, say 60 to 80% of the deal, depending on the size. Yep. You know, we have the other side of that on the promote. Yeah, nothing too non-standard. You know, we've been trying to, we're doing, you know, multiple asset classes. So you can be kind of a higher pref, no back end payouts. So say like a 9 pref.
Yeah.
With no upside.
Yep.
And then, you know, if you're a big investor, like 500K plus, you might get a little bit better split and a better pref.
Sure.
Just for economies of scale.
Yeah, absolutely.
And then we can bring in those, you know, kind of partners that can raise with us in that capacity.
Yeah. I love it. Yeah, it's good. We found we just kind of make things the same on every offering, and people kind of get acclimated to it and they know what to expect, and try to keep it as simple as possible. Well, good. Well, Chris, has been really enjoyable learning about your business. Wish you guys continued success. If somebody listening wants to connect with you, where do we send them?
You can reach me at emcapitalgroup.com, which is my website. And then my email address is Chris Lento, Lento at emcapitalgroup.com. Just send me an email and we can schedule a call.
Awesome. Well, if you're listening, you can go to the show notes and click through the website or send Chris an email. But thanks so much for your time. It was great to connect. And like I said, wish you a bountiful 2024 here ahead.
Thanks a lot. Same to you. It was very enjoyable.
All right. See you, Chris.
Bye.
Thank you for listening to the DJE podcast. For more information, please go to djetexas.com.